Hello, everyone. In this session, we'll discuss the various aspects of stock market structure. In particular, we'll look at the various types of exchanges, types of market orders, and other investment opportunities in both the US and abroad. Primary markets are where corporations raise funds through the issuance of stock. Most transactions go through investment banks like Goldman Sachs, which serve as an intermediary between the issuing corporation and investors. You can see this illustrated on the next slide. Investment banking arrangements come in one of two flavors. A firm commitment is a situation where the investment bank guarantees the price, what's called the gross proceeds, of the newly issued securities by buying the whole issue at a fixed price, what's called the net proceeds. The difference between the gross and net proceeds represents the underwriter's spread on the issue. By contrast, in a best efforts arrangement, the investment bank does not guarantee the price to the issuer, but rather acts as a distribution agent for a fee. In other words, they act as a selling agent in order to try to sell the shares to as many investors as possible. Now, typically, a number of investment banks will work together to distribute a new issue. This is what's called a syndicate. The leading bank or banks in the syndicate, which directly negotiate with the issuing company on behalf of the syndicate, are the originating houses. Each member of the syndicate is assigned a given number of shares in the issue for which they are responsible for selling. This helps to spread the risk of the issue over multiple banks. A primary market sale may be a first-time issue by a private company going public, what's called an initial public offering, or a seasoned offering, which is a primary market sale by a firm that has already sold shares that are trading in the secondary markets. In a public sale of stock, the investment bank must get SEC approval. The registration statement includes information on the issuer's business, key features of the security to be issued, the risk involved, and the background on the management team. The focus here is on full disclosure. The preliminary prospectus is what's called a red herring. It is similar to the registration statement, but is distributed to potential equity buyers. Now, because this process of getting SEC approval is lengthy and certainly costly, some companies use a shelf registration, which allows the firm to offer multiple issues of stock over a 2-year period with only one registration. Secondary markets are where stocks, once issued, are traded by investors. The original issuer of the stock is not involved in these transactions. In the United States, the 3 most well-known exchanges for these secondary market transactions are the New York Stock Exchange, or NYSE, NASDAQ, and BATS. Now, I should note that there's been an awful lot of consolidation over the last several years. To give you an example, NYSE Euronext was created by a merger of NYSE and Euronext. And when you look at NYSE, at the time, they had just purchased the 3rd largest exchange in the United States, which was the American Exchange, in 2008. And Euronext had gone through a series of mergers where they had acquired the Paris Bourse, the Brussels Exchange, and the Amsterdam Exchange. Then in 2012, NYSE Euronext and Deutsche Börse announced a planned acquisition that was ultimately blocked by European regulators out of concerns that it would create a monopoly. In the wake of the planned merger, the Intercontinental Exchange, ICE, which is a commodity and derivatives exchange, bought the New York Stock Exchange Euronext and spun off Euronext in an IPO in 2014. At the same time, NASDAQ was acquiring a lot of the regional exchanges. As an example, they acquired both the Philadelphia and the Boston exchanges, which are now a piece of NASDAQ. The New York Stock Exchange has 2,300 stocks with about $50 billion traded each day. Each stock is assigned to a special market maker, which is called a specialist. The specialist has an obligation to maintain liquidity, order flow, and prices in times when the market becomes turbulent. Now, while the specialist may be designated to serve as the market maker for more than one stock, only one specialist is assigned to each stock listed on the exchange. Trades on the New York Stock Exchange come in different sizes. A round lot is an order in increments of 100 shares. Block trades, on the other hand, are large quantity trades placed by institutional investors and typically are of 10,000 shares or more. And program trading can also be used. This is the simultaneous buying and selling of a portfolio of at least 15 different stocks valued at more than $1 million using computer programs. These are often done to reposition a portfolio. So as an example, if I was an institutional manager and took over a new portfolio, I may use a program trade in order to buy and sell the securities that would be needed in order to replicate the portfolio that best represents my view on the stocks that comprise that portfolio. This is a typical quote that you'd see in the Wall Street Journal or through a service like FactSet or Bloomberg. Note that in addition to the open, high, low, and closing prices, we also see the change, which is typically the change from the prior day's close, the volume of shares that were being traded, and the highest and lowest price over the last 12 months. I would note here that if you're using a service like FactSet, you can customize these quotes to get the information that you really need. As an example, rather than seeing the 52-week high and low price, what's more useful is to look at the difference between the current price and that 52-week high or low price. Similarly, you might want to incorporate the weight of that security in your portfolio, the benchmark weight, so you can look at how much of that current weight is active, and then the spread to your price target. This customization can be done quite easily in certain applications. Investors have two options with regards to purchasing stocks. They can take a long position or a short position. A long position is the most common and involves purchasing the security with the hope that the stock will appreciate in value. By contrast, a short position involves selling borrowed shares in the hope that the price will fall. The short seller will profit if the shares can be repurchased at a lower price in the future. Thus, the market offers the opportunity to profit whether you think that the stock will move higher or lower. It's important to understand the different types of orders that can be used to acquire shares of common stock. Most orders, probably in the neighborhood of 75 to 80%, are market orders. That is an order to buy or sell a security at the best current market price. A limit order, on the other hand, is an order to buy or sell a security at a specified price or better. The broker will only execute the trade within that price restriction. Finally, a stop loss order is an order to sell a security when the price falls below an established price. These can be used in order to protect profits that have already been earned or to prevent further losses if the stock drops to the price. Now, there are various types of accounts When you open up a brokerage account, it is either a cash account or a margin account. Cash accounts require that all securities purchased by the investor be paid in full without any indebtedness. By contrast, a margin account allows the investor to borrow funds from the broker to purchase securities. Now, the Fed sets the initial margin percentage, which is currently 50% of the initial purchase price. In addition, there's also a maintenance margin that must be adhered to, and that is 35%. And if the value of the portfolio falls below that level, then the broker will issue what's called a margin call, where they're going to ask for additional equity or additional collateral in that account. Here you see the calculations for the maintenance margin and the account value. Again, the maintenance margin is just the difference between the account value and the amount of debt that was used divided by the account value. So let's look at an example. An investor purchases 100 shares of William Global stock for $104 per share. The stock is purchased on margin. If the initial margin was 50% and the maintenance margin is 35%, at what price will the investor receive a margin call? So what we're being asked here is, at what price will the stock have to fall to before we'll be asked to put up more collateral into that account? And so the way that we would set this up is we would take the amount of debt. So remember, in this case, the initial margin is 50%. So they would have borrowed half of that, or $52, and use cash for the other $52. So the debt's $52, and we divide that debt value by 1 minus the 35% maintenance margin, or by 0.65. And if you divide 52 by 0.65, you're going to get a value of $80. So if the stock was to fall from the $104 to where we bought it down to $80, we would receive a margin call. And that would require us to have to put up more money into that account as a form of collateral. NASDAQ is the world's first electronic stock market, and it has no physical location. In fact, I was down there last year with a group of students who were participating in the CFA Equity Research Challenge. And just so happens that one of my former students is the head of new listings for NASDAQ. And so I reached out and asked if we could go in for the closing bell ceremony. And when you go in, basically it's a TV studio where the time counts down to the market close at 4 p.m. and you've got everybody up on the stage, it's clapping and the bell's ringing and so forth, but you don't actually see any trading that's going on because it's all electronic. Now, NASDAQ is primarily a dealer market in which the dealers are the market makers who stand ready to buy or sell particular securities. Unlike the New York Stock Exchange, many dealers will make a market in a single security. Now, when the request for a trade is received, the dealer will use NASDAQ's electronic communication network, what's called an ECN, to find the lowest ask or the highest bid for that transaction. Very small firms are going to be on the over-the-counter or OTC bulletin board, which is a means for brokers and dealers to get and post current quotes on those small companies. These small firms are mainly penny stocks, which are stocks that are traded for a per share price of $5 or less, and generally issued by higher risk firms with short or erratic histories of revenue and earnings. There are actually about 30,000 stocks, believe it or not, that trade in this over-the-counter market. The smallest stocks are going to be listed on pink sheets that are distributed through the NASD. The OTC quotes are recorded manually and published daily on pink sheets that the dealers use. The major stock markets are open from 9:30 a.m. until 4 p.m. Monday through Friday. Extended hours trading involves any security outside of those regular hours. Almost all extended hours trading is processed through ECNs like Archipelago, which is owned by the New York Stock Exchange, Instinet, which is owned by NASDAQ, or BATS, which is an acronym for Better Alternative Trading Systems. Now, there are some anomalies that have happened in the markets. As an example, on May 6th of 2010, the financial markets experienced a brief but severe drop, falling nearly 1,000 points, or more than 5% in a matter of minutes, only to recover a short period of time later. I remember at the time I was called into the CIO, the Chief Investment Officer's office, and we were on the phone with our primary trader trying to get in as many trades as we could, as we saw stocks that we really like falling precipitously, and we couldn't see any fundamental reason for that to be happening. So we tried to execute on those trades. Now, the way that it played out is a lot of those trades were actually canceled because the regulators analyzed the possibility that the free fall was caused by some sort of erroneous order by computer hacking or even terrorism. Now, it turns out that it wasn't. Rather, it was attributed to trading by a little-known mutual fund called Asset Strategy Fund. And the fund had triggered the fall in the sale of 4.1 billion of futures on the S&P 500 index. And the trader used a computer algorithm that was tied to the sale of the market's overall volume. So trading volume soared on May 6th, and the sell order was executed. Now, regardless of how this historical drop started, it was exacerbated by computer trading. Again, algos kicked off additional sales, increasing the selling pressure and putting that downward spiral on the market. And so what basically happened was that the initial trade triggered a pyramiding effect from computerized trading that was designed to sell when the market moves lower. So as a result of that, the New York Stock Exchange and NASDAQ have introduced trading curbs, which are commonly referred to as circuit breakers. Now, when circuit breakers were first put in place, the reference index on those was the Dow Jones Industrial Average, but that's now been changed to the S&P 500 index. They've also revised the rule that made a reduction in the market decline percentages threshold necessary to trigger the circuit from 10, 20, and 30% to 7, 13, and 20% moves from the previous day's close. They also shortened the duration of the halts from 30, 60, or 120 minutes originally to 15 minutes, as you can see on this particular slide. Now, if you want, you can go on to either the New York Stock Exchange or NASDAQ site, and if you look at their market regulations section, they'll provide very detailed information on these circuit breakers, what they're designed to do, and how long they're in place, given the amount of the drop. Market performance is measured through an index, which is a composite value of a group of publicly traded securities. It can also be used to evaluate active managers who are benchmarked against these indexes. Now, typically there are two broad categories of indexes. They can either be price-weighted or cap-weighted. The constituents of a price-weighted index are weighted, not surprisingly, by price. So The most well-known price-weighted index is the Dow Jones Industrial Average, or Dow. You can think about it as an old school index comprised of 30 large companies that were selected by the editors of the Wall Street Journal. The editors look for the largest companies with a history of successful growth and ones that are interesting among investors. The prices of the companies in the index are added together and then divided by an adjusted divisor. I say an adjusted divisor because while it was originally 30, one for each company, with all the stock splits and stock dividends over the years, the index now is down to about 0.1. Now, the other type of index is a cap-weighted index. And so with a cap-weighted index, the companies that are largest in terms of their market capitalization, price multiplied by shares outstanding, are going to have the biggest weight in the index, which obviously makes more sense than having it be price weighted. Now, the S&P 500 is probably the best known of the cap-weighted indexes, certainly within the United States. And here you have the 500 largest companies in the US by market cap. I would note that the movement in the S&P 500 is highly correlated with the New York Stock Exchange Composite Index, because the S&P 500 is comprised of about 80% of NYSE companies, with the remaining 20% coming from NASDAQ. A couple of others here. The NASDAQ Composite Index is just a evaluated index of all the stocks that trade on that trade on NASDAQ. And then the Wilshire 5000 Index is notable because it's helpful to have a broad stock market index. And certainly the Wilshire 5000 is an accurate reflection of the overall market. Now, I would note that with the lower number of stocks that we have today versus historically, you don't actually have 5,000 stocks in the Wilshire 5000 these days. I think that number is down to less than 3,000. I'd also note that in addition to these broader market indexes, we can cut indices in a variety of different ways. One example is we could look at, say, the S&P 500 and divide that into two camps: those that are more growth oriented and those that are more value oriented. We also commonly take a look at an index like the S&P 500 and group it out by economic sector. So as we'll see when we look at funds, ETFs can be used to invest in these sectors on either an equal weight or a market cap weighted basis. Now, for the S&P 500, we use what's called the Global Industry Classification Standard, or GICS, which is a means of dividing companies up by the 11 economic sectors. The price of a stock is equal to the present value of its future cash flows. So to the extent that the company's stock price today reflects investors' expectations of future cash flows, the stock market index can be thought of as a means of forecasting future economic activity. In other words, an increase in the stock market index today potentially signals the market's expectation of higher corporate profits and, in turn, higher economic growth in the future. The degree to which financial security prices adjust to news and the degree or speed at which the stock prices reflect new information is referred to as market efficiency. Now, there are conflicting views on market efficiency, but there are basically three different forms: the weak form, semi-strong form, and the strong form of the efficient market hypothesis. With the weak form, basically, an investor would be able to use historical news, historical prices, and volume information to consistently predict future stock price changes. This is sort of the what underlies technical analysis, this idea that prices trend over time, and we can use this historical information and price data in order to predict what's going to happen in the future. The semi-strong form is what most fundamental investors will buy into, which basically says that you can use publicly available information, including financial forecasts, in order to predict future stock price performance. And then finally, we have the strong form. And under the strong form, the view there is that you would have to use all information, including inside information, if you could expect to consistently predict future stock price movements and be able to outperform the market. So clearly, if you have a semi-strong form view on the markets, then you would be much better off investing passively than you would actively. So before rounding out this session, I did want to talk a little bit about stock market regulations and investing abroad. So stock markets and market participants are obviously subject to regulations that are imposed by the Securities and Exchange Commission, as well as the exchanges on which the stocks are traded. The main emphasis of SEC regulation, as I had mentioned earlier, is on full and fair disclosure of information on securities, and they want that information to be disseminated not only to current investors, but also potential investors. Now, there are a couple of acts that really sort of underscore everything that's done through the SEC. The first is the 1933 Act, which required listed companies to file a registration statement and to issue a prospectus that details the recent financial history of the company when they issue a new stock. Then the 1934 Act established the Securities and Exchange Commission and gave it authority to monitor the stock market exchanges and administer the provisions of the 33 Act. I should note that the SEC is also responsible for investigating and prosecuting insider trading cases. So FINRA is the largest independent regulator of all security firms in the United States. It was created by the 2007 merger of the NASD, which was the National Association of Securities Dealers, and the regulatory arm of the New York Stock Exchange. FINRA oversees registering and educating brokers and dealers, examining securities firms, promulgating rules, enforcing federal securities laws, and conducting dispute arbitration between investors and registered firms. As an example, if you want to be a broker, you'll need to have certain licenses, including the Series 63 and 7, and these licenses are administered through FINRA. US stock markets are the world's largest, but international stocks are attractive to investors because some risk can be eliminated, in other words, diversified away, by holding the stocks issued by corporations in those foreign countries. While the markets generally move together, the correlation in movements is not perfect. And as we know, anything that's less than perfectly positively correlated will improve diversification. That said, there are some costs. Specifically, information on foreign stocks is less complete and less timely than it is for US stocks. And in addition, international investments introduce foreign exchange rate risk and also political risk, which you'll oftentimes hear people refer to as sovereign risk. Now, a means of investing in international stocks without actually using an international exchange is what's called an ADR, or an American Depository Receipt. An ADR is just simply a certificate that represents ownership of that foreign stock. And the way that they're created is a US bank buys a stock in a foreign corporation in that domestic currency and places it with a custodian. The bank then issues dollar-denominated ADRs backed by the shares of that foreign stock. So each ADR is a claim on a given number of shares of stock held by the bank. These ADRs are then traded in the United States in dollars on and off organized exchanges. Now, there are basically three different levels of ADRs. A level 1 ADR is the most common and the most basic of the ADRs. As a result, they have the least amount of regulatory requirements as stipulated by the SEC, so they only trade on the over-the-counter market. One thing I should note about these level 1 ADRs is that they do not abide by the US accounting standards, which is GAAP, nor do they have to issue an annual report. That's not true for a level 2 ADR. And as a result, the level 2 ADRs are much more liquid than a level 1 offering because they're required to register with the SEC, to file a Form 20-F, which you can think of as being equivalent to a 10K, and to file an annual report that complies with the GAAP standards. Finally, level 3 ADRs represent the most respected ADR level. The foreign company can actually issue shares in the US markets in order to raise capital if they're a level 3 ADR. So just to recap here, certainly there are some advantages of using ADRs or even stock in international companies that you can get directly through foreign exchanges. But one thing I would note here is an advantage of the ADR is that it has fees that are lower than those of many international mutual funds. And at the same time, you're getting the additional diversification that you're looking for. But again, you have to be aware that these international investments do create some country risk, certainly some foreign exchange rate risk, and some accounting risk if the companies aren't required to adhere to the same strict reporting standards. So hopefully this was a helpful video in terms of understanding the basics of stock market structure. What I would note here is that in the next session, we'll explore equity research and valuation. Thanks for listening.